How's it going, everyone? My name is Arthur and welcome back to the channel. Today we're going to talk about something that I think is going to be a pretty hot topic over the medium term, and that's inflation, and more specifically what inflation means and the general effects of inflation on the economy and the stock market. But before we get started, I wanted to highlight that this is not financial advice, and everything I'm covering here is solely for the purpose of exploring what inflation means and its potential effects on the stock market and the economy. Please make sure you do your own research and know what you're investing in before you make any types of investing decisions. So first of all, I just want to start off speaking about what inflation really is and is it really all that bad? So in simple terms, inflation is the increase in prices of goods and services that households typically buy. Now, a very common measure of inflation is something called the Consumer Price Index, or CPI. And what the Consumer Price Index measures is exactly that. So it's the percentage change of the price of a basket of goods and services that a household buys. So in the US, this is generally calculated by the Bureau of Labor Statistics, or the BLS. And in Australia, it's calculated by the ABS, or the Australian Bureau of Statistics. So hopefully that doesn't sound too much like a bunch of mumbo jumbo. So I think it's probably worth to go over a number of things that may explain some major causes of inflation in our modern world. So there's a number of different things that we can talk about here, but I think I'm going to focus on three. So number one is demand pull inflation. So demand pull inflation is basically the upward pressure on prices that often follows a shortage in supply. In other words, there are too many people that want to buy only few available goods. So ordinarily, the price for those goods rise. The second one is cost push inflation. Now, cost push inflation can be categorized as increased prices due to the increased cost of wages and other input costs such as materials. So in general, cost push inflation really occurs when the higher costs of production decrease the aggregate supply curve. And in essence, what's happening here is the complete opposite of the demand pull inflation side. I'll throw some graphs up here so you guys can see this graphically. So here we have the two graphs of demand pull inflation on the left and cost push inflation on the right. So let's start off talking first about demand pull inflation. So let me quickly explain what's happening here. On the x-axis, which is labeled y here, we're talking about quantity, and on the y-axis, we're talking about the price. Now the lines represent here AS is aggregate supply, and AD is aggregate demand. So from demand pull inflation, what happens is AD dash is the new aggregate demand line that has been pushed out to the right. And as you can see here, the intersecting point with AS, we can see that there's an increase in quantity from the original aggregate demand curve. And subsequently, we have an increase in price. Now, a couple of things can cause demand pull inflation, such as a general increase in customer spend, things like investment spending, as well as government stimulus. So here we can see increase in prices, largely due to a demand side factor. Now, moving on to the right with cost push inflation, it's practically the complete opposite of the demand pull inflation. So once again, we have price on the y-axis and quantity on the x-axis. The original two lines are AD, aggregate demand, and AS, aggregate supply. However, now we see a shift to the left in the aggregate supply curve, which results in a decrease in quantity, and the intersection point with the AD, aggregate demand line, we see an increase from the original price. Now, some key factors behind the aggregate supply curve shifting left include the rise in key input costs, potential changes in size and quality of labor, as well as potential increases in wages. Now, at the moment, it's no secret that inflation is creeping up. Now, currently, as I film this video, the consumer price inflation rate is roughly 5.4%, and that's the number that was quoted back in July 2021. As a reference point, it was only 1.4% back in January 2021. And as a reference point, in Australia, the inflation rate has jumped from 1.1% back in January all the way to 3.8% as of July 2021. It's not quite as large as the US, but still it's a decent leap. As a general reference point, the target inflation rate is usually about 2%, and this target is set by the central banks. Now, in addition to demand pull inflation and cost push inflation, there's one other thing that I want to mention, and that's printing money. Now, what printing money basically does is it dilutes the value of the dollar. So in general, the more stimulus packages that the government gives out, the more support payments, all of that contributes to consumer spending power, which does two things. In the short term, it certainly stimulates the economy as people are able to go out and spend their money on things they want. And of course, the second thing it does is it adds to that inflationary pressure. Now, I have heard a number of figures in terms of how much money has been printed in the last 12 months. For example, in the US, I have heard from 26 to 40% of US dollars has been printed in the last 12 months, which is pretty mind-boggling to think about. The question is, where's all that cash going? So in general, with the stimulus checks, the government hopes that this money will do a couple of different things. Obviously, they hope it will help out in terms of spending on some necessities such as food, any emergency payments that people may have. So the hope is that the money goes back into the economy, which creates that stimulating effect. Now, what often happens with this cash is that people put it into saving accounts, people put that money towards paying off their debt, and also a large portion of that money would be going into investments such as investing in the stock market and even cryptocurrencies. So going back to the idea of demand pull inflation, naturally too many dollars chasing too few goods is going to result in some inflation. So now you might be wondering,
well, you just said 2% of inflation is good, but now you're telling us inflation is bad?
and that's an excellent question. Theoretically, inflation helps increase the production in the economy. So more money means more spending, and more spending translates into increased aggregate demand, and that demand in turn should trigger greater production in order to meet that demand. In a healthy economy that's growing, that process generally results in some amount of inflation, and as I said, that target is generally 2%. However, when an excessive amount of money is printed, what happens is there's no real productivity that's backing that cash. So printing all this new money doesn't necessarily increase the economic output, even though it might seem like that in the medium term. Now, here's where it becomes interesting, because in a normal, healthy economy where inflation is running at around 2%, in theory, if you have cash sitting under your bed, not gaining any interest, that money is actually losing value. So in general, to preserve the value of your cash, people throw it into savings account that yield interest rates. Some common ways used to hedge against inflation include investing in gold and commodities, and to some extent, even the stock market. Now, the reason is, if you look at the average annualized return of something like the S&P 500, it's roughly 10%. So if inflation is running at around 2%, investing in the stock market seems like a great idea. But here it is, what happens when inflation is far above 2% and people are speculating that it could go even higher? So basically, as inflation approaches that average return of the S&P 500, the less attractive the stock market becomes. And here I want to talk about two factors that are quite important. In general, the rise of a stock's price is highly reliant on company earnings. And that's true for the market as a whole. And this is where inflation comes in. Because as we said earlier, inflation may result in higher input costs and higher costs of labor, which ultimately eat away at the bottom line earnings of a company. And this can affect the entire market. Now, in addition to those increases in input costs and labor costs, what is likely to happen in periods of abnormal inflation is the government utilizing contractionary monetary policy in order to curb some of those inflation effects. So the purpose of this is to reduce the money supply in the economy, which happens by decreasing the price of bonds and raising interest rates. Now, what this generally results in is an increase in borrowing costs, which often affects the entire stock market. So as interest rates rise, bond prices go down, and in general, bonds as an investment tool becomes more attractive due to the increased interest rates. Now, depending on how attractive those yields become, it can start to eat into the attractiveness of the S&P 500. And as a result, there is potential to see a significant outflow from the stock market into bonds, potentially higher interest yielding savings accounts. And that's what has the potential to trigger a landslide in the stock market. Now, I wanted to touch on two investment vehicles that are closely related to interest rates, and that is two ETFs called TBT and TLT. I'll pop them up on the screen. So TBT is an ETF that essentially allows you to place leverage bets on interest rates rising. Now, what that means is if investors believe that interest rates were going to rise, they might buy into TBT. Now, what's important to consider here is that TBT is not a buy and hold ETF. Because of its riskiness and the fact that it generally goes up when interest rates rise, makes it very much a short-term and a tactical instrument. Now, next to TBT, we also have TLT. So TLT tracks a market-weighted index of debt issued by the US Treasury with remaining maturities of 20 years or more. So in basic terms, TLT acts as an actual bond in terms of the relationship between price and yield. As interest rates go down, the TLT price would go up. So if you were an investor betting on interest rates going up, here you would actually take a short position in TLT. Now keep in mind, both of these are very much short-term tactical instruments. I am in no way suggesting you should go out and take a position in any of these. I just think they're really interesting and worth covering for the purposes of this video. And these are certainly not the only two. There are a number of investment instruments that track interest rates in a similar way. So to sum everything up, continued inflationary pressure may result in increasing interest rates. Those rising interest rates in turn may make investment into bonds more attractive than the returns provided by the stock market or the S&P 500. And that may result in money leaving the stock market and going into something like bonds. Now, I think it's important to keep in mind that this is highly reliant on the continuation of inflation and how bad it gets, as well as how aggressive of a position governments take in terms of raising interest rates, or maybe exploring other policies to curb inflation. So that's all on inflation for today. Thank you guys so much for watching. Please let me know what you thought down in the comments. Let me know if you have any questions. If you enjoyed the video or learned something, please subscribe, look at the graph. We're on our way to 10,000 subscribers. Please let me know what you guys think, or if you have any questions down in the comments. Thank you once again for watching, and I'll see you in the next video.